Ladies and gentlemen, it's Modern Investing on Pod TV. My name is Sasha Starr, and we have guests today, Dr. Milan Samperk. Well, welcome to the show.
Thank you for inviting me. Delighted to be here.
Likewise, and Jim Eid from Eid Foundation. Welcome to the show, Jim.
Thank you, Sasha. It's great to be here.
Great to have you always. I just before we started the show, I had a discussion with Mark about the other financial shows and what's happening there and so on. It seems to me that, for example, there is one show when very heavily being promoted the energy and energy stocks, and we haven't touched that area for last several months or maybe even never. And what I heard today on CNBC, which is right behind me, that energy was the worst performer sector for the last quarter, and guess what? For the last year.
Wow.
So there must be a reason why we never touch energy and energy stocks. And thanks to that, I hope people who are following us, they haven't lost a shirt, a pants, and some more valuables by following the.
Here's a possible reason. You tell me if it makes sense.
Yes.
COVID has created a situation where many people are effectively working from home. And so there are not as many cars on the road as there used to be before COVID, and hence the need for energy, gasoline particularly, is down. You can see that the traffic is down when you're driving. So would that be one of the reasons?
In Toronto, I wouldn't agree with you because in Toronto, traffic is extremely heavy. The only thing is you can see more electric vehicles on the road. That's true. And I think that what was built up in the prices and people expected them to go much higher was a war in Ukraine and the plot of Saudi Arabia and others to restrict the output, and so therefore the price would go higher. And although everything is happening there and they're lower their output, the war in Ukraine is still raging, but I think it was already built up in the prices, and from what I see now, I mean, they're just moving lower. At least they're not moving higher, that's for sure. So some people who suggested that in a few months we will see prices of $150 per barrel, or maybe 200, and whatever is definitely not there. What, Jim, do you think?
Well, I think that people have had an obligation to move off of oil and fossil fuels for a long time, but people didn't do it. But once the prices started to go through the roof, people got motivated. And you're seeing this move to electrical vehicles. You're seeing a lot of related moves. And countries are now putting their own energy into alternative energy sources. And so all of this has been a global phenomena because people no longer trust that their supply of oil is going to be available as it was when we were all being part of a global community. When we have rogue elements deciding whether or not they're going to profit excessively by, or using it as a weapon to keep you in line, then people start to decide, I want to be free of that. And so we're seeing that phenomena. I was not aware that the energy sector had been down for the entire year, because it's one of those.
Not just down, but the worst performing sector of all 11 sectors of U.S. economy.
Yeah, because it's one of those that kind of goes up and down, but to have it last that long, that's a trend, and that's something to pay attention to. Absolutely. And so we can speculate as to causes. But it's important to realize that until that trend changes, expect it to continue.
Jim, you were talking, you were just touching the subject of possible shortage of oil. But it seems to me that another reality is taking place. There is abundance of oil, and in a few years from now, I'm talking about maybe 5, 10 years, nobody will need so much supply of oil as there is one
Yeah,
available
yeah.
today. Tell me, Milan, what do you think about it?
Um, uh, I'm so old that when I was a student, I worked on the railroad for 8 summers. During the summer, I worked on the railroad, and they were using steam engines in my lifetime. When's the last time you saw a steam engine pulling a train? And oil is also a temporary source of energy. How temporary is difficult to tell, but like steam disappeared, oil and coal will disappear someday as well.
Well,
Okay.
it's important for for many reasons. Climate, the primary one, that we wean ourselves off of these fossil fuels. They're a finite resource to begin with, and our appetite for them was insatiable. And so this is healthy for on many respects, for the air that we breathe, for the economy in general, to have multiple energy resources. And we're seeing this with the invasion from Russia into the Ukraine. We're seeing that the global stability, we can't take that for granted either. And so it's the same with the semiconductor chips. People are now saying, hey, we need to manufacture these at home because we can't rely. So what if we can restore some sort of civilized global community where we're not invading each other, we're not cutting off the supplies of our resources so that they suffer, vice versa, and that kind of thing. And that's a big if we'll ever do that. But I think that countries are still trying to become more and more independent, less reliant, because we became reliant on other countries. And now we're kind of thinking, oh, geez, maybe we need to be able to manufacture at home too. We saw this in the pandemic when the first responders for the people that were taking care of the first people who were sick, they needed protective equipment, and the distribution wasn't available, so they couldn't get it because we didn't make it here in the United States.
Yeah, right.
And so now we're thinking, gosh, we have to have that capability. We can't afford that anymore. And this is, I think, a long-term play in the energy sector. It should be cautious because its future is not looking too bright. But they're so entrenched, and I think that they own so many politicians. They funded their campaigns. They funded these people. So there's still policies will still be favorable to them for a long, long time. So they're not going away overnight.
No, policies, I agree with you, but it's a natural supply and demand. It's still, in the long run, will drive markets one way or another. And it seems to me that supply is there and demand could be dwindling. Milan, what's your opinion on today's market?
Well, a couple of things I'd like to say. First of all, let me philosophize for a moment and remind our viewers of the story of Kurt Vonnegut and Joseph Heller and Heller's book, Catch 22. Heller's book sold 10 million copies. If he made $1 a copy, I can figure out how much money he made. If he made $5 a copy, which is much more likely, I can't figure that one out because it's such a big number. And so Joseph Heller and Kurt Vonnegut were close friends, and they were at the estate of a hedge fund manager. And Vonnegut says to Heller, you realize, Joe, that our host made more money last week than your book did in its entire run? And Heller said, yeah, but I have one thing he'll never have. And what's that? Enough. Enough. So now, if the stock market has gone up on an average of 10% annually with huge fluctuations, as much as 30%, but 10% annually over 100 years and 6.5%, so inflation adjusted, and all money managers and advisors tell us to withdraw 4% annually from our portfolio to live on. And we're doing that in a market that's going up by more than 4%, 6.5%. Who needs more? Do we not have enough? Are we not going to be like Joseph Heller and say, there's one thing I have that the hedge fund manager will never have enough? So now, equaling the S&P 500 is something that we can teach a high school student in a matter of 15 minutes. Beating it is damn near impossible in the long run, in which we should invest in the long run. In the short run, yeah, you can beat it. So that's my philosophical statement that I have to make about investing generally. Now, let me get specific about forecasting. You said when you're speaking, Sasha, you said something about what is going to happen in a few months. We don't know. Forecasting, we tell our members of Monday Morning Millionaire, we have about 300, we tell them to look at all forecasts and predictions for amusement only. However, the put-call ratio seems to be fairly accurate, that if open interest in puts, people buying puts, is higher than people buying calls, that means that the market sentiment is negative. Conversely, if people buying calls, the ratio in open interest is higher than people buying puts, that means that we're looking at a positive outlook. And so what happened with my portfolio on Monday, a week ago Monday, I had sold covered calls on SPY, expiry date Friday of the same week, and $5 out of the money to allow for some growth, should it happen. Well, growth did happen, and it went up by more than $5, and I was assigned, and my SPY stocks were called away from me, and I was entirely in cash. Now, the following Monday, that Monday of this week, I looked at the market sentiment by looking at the put-call ratio, and it was negative. And the best place to be in a declining market is in cash. And I was in cash. So I say, hey, I'm staying in cash. So my bank gives me yesterday's result. Today's Wednesday. They could give me the result on Tuesday. So what happened was that yesterday, the market was down 0.85%, while my portfolios were up 0.30%. And the reason they were up is because they're expressed in Canadian dollars and the US dollar went down. So because the US dollar went down and I had followed the put-call ratio advice and stayed in cash, I actually made money in a declining market. And so I checked the put-call ratio this morning as well and remains negative. So I'm staying in cash, which is the best place to be in a declining market. So there is my philosophy, Heller-Vonnegut catch-22 story, and what actually happened in my portfolio. And it's not because I'm smart, it's because I was lucky this time.
Excellent. Whether you're lucky or you're smart, and when there is a positive result, that's what all counts. That's very important. I tend to agree with everything what you just said, and the reason I'm pursuing quite aggressive trading in my fund account is that you see every day trillions of dollars are changing hands.
Yeah, right.
And my philosophy is if I can catch a fraction of a percentage of these swings, I can hugely benefit from it. And if it's not a guessing game where I just throw darts and just trying to guess what's going to happen, but I'm trying to educate myself. I'm learning different trends in the market. I'm going through some investigative research if needed, although it doesn't necessarily help you a lot because market conditions are changing and very quickly. So whatever you learned yesterday, today may not be valid anymore.
Listen, I've known you for a little over a year, and I have concluded that you are a market wizard. And that certainly doesn't apply to most investors. Most fund portfolios trail the market. They don't equal it, they don't surpass it, they trail it. And so how much fun are those people having who have these kind of fund portfolios? If the size of their portfolio is small enough so that it means nothing if they lose it entirely, they could have some fun without having to go to Las Vegas. They can do it from the kitchen, from their living room. But you are quite exceptional, and you can't expect everybody to be like that. We have to work with what is most likely to happen. We're not market wizards, at least most of us aren't, and you are.
Yeah, maybe you're right. But I must admit that everything what I'm doing is, in my opinion, there is nothing exceptional, really, because everybody knows about stocks like Lululemon or Nvidia or just recently, what else was Palo Alto Network, which is spectacularly well, especially Jim. You would be one, should
Yeah.
have been one who would say, "Okay, guys, it's time to move in the Palo
Yes.
Alto Network." So I don't see any exceptional to that because all this information is readily available, and I'm not using some kind of signals from outer space or some inside
Okay,
information.
if that's the case, why are most fund portfolios trailing the market?
Well, I've got a story to tell you that might be illuminative
Okay.
in terms of this. I just had a conversation this morning with a guy, and he was. We had a mutual friend who passed away, and that mutual friend used to call him at 5:30 every morning and start talking to him about what kind of options trading he should do that day. And so he was doing very well. And then when that fellow passed away, he said, "I've been losing my shirt," and it turns out that he was getting really good advice. And then when he tried to do it on his own, he couldn't do it. And he came to that realization, not, he didn't lose too much, but he became aware that he just didn't have it. He didn't have what it took
That would apply to most investors, wouldn't it?
and I think you're both right in the sense that the information is available, and there are people that can use it wisely. But the wide, well, a certain segment of the population can do that, and they may not be in a majority. And the majority of people may think that they can do it, but can't. And the deal is that what Milan was talking about is he didn't get lucky so much as he stayed disciplined. He stayed disciplined to what he does. He has his formula, he has his plan, and he followed it, and it rewarded him. And what Sasha does is he has his plan and he follows it, and he has been rewarded by doing this. And a lot of people have no plan. They listen to the people on CNBC or somebody, or they have a plan and it's a bad one, and they don't necessarily learn from their mistakes.
They buy a security.
Learn.
They buy a security because the name of the security is the same as the name of their dog.
Well, then they have no words for them. I don't think we can help them. But the thing is to know yourself and to know to either have, stick to what your discipline is, to have a good discipline, a sound discipline, and stick to it, or
So it is important, yeah.
or invest in the time and energy that it takes to use this information and use it wisely. And your track record will teach you whether you're good at it or not.
And it's very easy. You eliminate all red and keep your greens. And once you have all greens, you're making money. Jim, by the way, it's in chess has been suggested that it's better to have a lousy plan than no plan at all.
I've often said that.
Oh, you did? Oh, okay.
I agree with it in principle, but because I do believe that having some structures, having some idea of what you're doing is better than to be floundering and just guessing. But the fact is if you have a bad plan and you become aware it's a bad plan, you have to be open to changing it.
Absolutely. And also, you always have a chance that even if your plan is lousy and there is some kind of a hole at some point in your plan, but your opponent, by trying to fight your plan and your ideas, he may overlook something on its way and you may capitalize on that. So when you have no plan, now, if you are Karpov or Carlson, these two people they can play any positions without any particular plan and adjust to an opponent's plan or so on. But it's very few people on that.
Yeah.
Hey,
Nice
Sasha.
pros.
Hey, Sasha, quick question for you because I was listening in the background and everything, and I know some folks that are not so much in the investment space, but they are in the gambling space. And it comes down to something that Jim just asked recently and everything, which is that in the investment space, I get that you have to have skill and you need to know what you are doing, but is there an element of luck that is involved in as well? Because I know some people that have made some money off of fantasy football and made money literally betting on the color. It comes down to what Milan said. They betted on the color, they betted on the names, they betted on a number of other things. It didn't have anything to do with the skill set of the player or anything. And there are some folks that made a significant amount of money doing that type of betting. So can you do that in the market? Can you get away with the luck aspect and make money by just being plain lucky?
Are you
I
a chess
spent,
player, Mark?
yeah,
Huh?
go
Are
ahead.
you a chess player, Mark?
I have played the game on occasion. I'm nowhere near the level of Jim or Sasha or anybody else here in this room, but I have played the game.
So here's a question I have to ask of chess players. Using puzzles can improve one's chess.
Correct.
Puzzle is not, it's very often a part of a game. They stop a game and say, what's the next best move? So using puzzles, pretend game of chess can improve one's chess. The equivalent of investing is having pretend portfolio which has pretend $100,000 in it. That does not improve one's performance in investing, in my view. It has to be real money so that when you lose real money and not pretend money. There's a big difference between using chess puzzle to improve your chess and using a pretend portfolio hoping that it'll improve your investing. It won't.
But hold on a second. On those same kind of lines and everything, sorry, this Sasha. On those same kind of lines, I do know some people that are very familiar with a board game, and they will sometimes use their investment strategy in a similar way that they do that board game. And I'm talking about the board game of Monopoly, because I do know some people that will literally invest in the way that they saw their investments in Monopoly. So they may invest in a hotel, they may invest on a railroad. Y'all were talking about railroads earlier. They may invest in some of these other kind of spaces because that is what they remembered when they grew up playing those games, because some of those games are how people learn about finances and all of that.
Here's an important aside. Monopoly was invented by a Canadian. Continue.
I would like to remind you a story about now, of course, deceased Grandmaster Levenfish, who was a very, very esteemed player, philosopher. He was an engineer. He was a very, very good friend of ex-champion of the world, Vasily Smyslov, and they wrote together a fantastic book about endgames.
Yes.
And he was doing a lot of lectures. And when there was after lecture, the fan came over to him and asked, "Could I ask you a question?" And Levenfish said, "Yes, please do." He asked, "How could they really very quickly improve my game of chess?" And Levenfish told him, "You just play a ruble a game and you improve very, very quickly."
So you're doubling down on what Milan just said. Put your money up.
Absolutely. So when you are playing and there's no money involved, and you say, "Okay, I buy this, I sell this, and so on. Good luck, amuse yourself," but you'll never learn anything by doing that. The only time when you learn when real money is on the table. Another thing, what I'd like to tell you, Mark, is that to keep your money is much more difficult than to make money. Because you can make money by fluke, you can get lucky, you can get whatever is the inheritance.
This is important.
But to keep money, Jesus, it's so difficult because, okay, supposedly, okay, you can take all to cash all your accounts and so on, put it in treasury bills and so on, just to keep it all. But most people cannot do that because the market, and they were successful in order to make this money. So you want to continue and be even more successful, and why not? But it doesn't work well. You need strict money management skills, and this is not by fluke that almost every Friday I'm going 80% into cash on my accounts. Not just a fun account, not the other one. And the reason that I'm doing this, I don't trust the market from Friday to Monday, especially if it's a long weekend, then we're talking about Tuesday. So today is Wednesday, is the second day of the week, so tomorrow is is
A real
actually
Wednesday. Yeah.
Wednesday-like, and I hope tomorrow market.
Sasha, what you just said was articulated quite a while ago by Peter Drucker. Peter Drucker is a renowned management guru. The Japanese are following his advice. And Peter Drucker stated that managing money intelligently is much more difficult than making money. So you get somebody like Warren Buffett, who, never mind, he's not one of your market wizards, but he's been very successful when it comes to managing that money as a charitable activity. He has put that in Bill Gates's charitable fund to have somebody else manage it, because he has a proven track record of being able to make money, but he's not sure of himself when it comes to charitable use of that money.
We've often mentioned on this show the preservation of principle. And when we have a hot streak based on, let's say, I'm in fantasy football and I'm betting on team mascots. I like this team's mascot better than the other.
Yeah, that's right. Yeah.
So, I could get hot, no question. But can I do this long term? The answer is, yeah, you can do it long term, but will you be successful? I doubt it. Because team mascots don't give you the edge that we're talking about. There is an edge to be had here. Not for everyone, because not everyone is cut out for it. But for some people, if they're disciplined and if they pay attention to the information and use it wisely, they can make money over time. Now, Milan has a strategy that works for him, and it works for a lot of people. There's no question about it. Sasha has a different one, and it works for him. And it does. This is defensible. Both, they're both right. It depends on how your personality, and to be aware of yourself, what your likes and dislikes are. If you like following the market, and we talked about putting money on the table, this is true. I started betting on the golf majors with a friend of mine, and I know so much more about the golf players than I ever used to, because I'm betting a lunch. It's not a big amount of money, but it's also bragging rights. So I'm paying much more attention to all the information that I can get if I wasn't doing that at all. So,
hey, Jim, along those same lines, too often we hear people that get rich quick, and they definitely have that get rich luck ability and everything, and then all of their relatives and their business partners come out of the woodwork. And how many times have we heard of the athlete or the lottery winner that goes broke because they have found all of these unknown cousins and these unknown relatives that are automatically trying to come after them, and all in that space. So it comes down to something that Sasha says they probably need, as soon as they get that money, some sort of money manager to help them if they don't have those kind of skill sets. A lot of them don't have those skill sets.
That's right.
I think I mentioned on a previous show that the record shows that if someone makes $1 million before age 21, he's got an 80% chance of dying broke.
Yeah, I can definitely believe that. Hey, just really quick, I know that Sasha, I had mentioned it to Jim earlier, and I mentioned it with the monopoly analogy, but there is the airline industry, and there's the very popular airline industries. There's the Deltas, there's the Americans, there's the JetBlues, and all of that. People are talking about this train industry, and I know we're even talking about rail here in North Carolina, where we're going to have companies that people will be investing in that rail space, and should people be looking at that rail space? Because I'm imagining there's going to be a kind of a battle among those kind of companies if rail is going to be something in the Americas and all in that space. So will we see the development of, say, a Delta or an Eastern or something like that in the rail space, and should people be paying attention to that as a investment opportunity?
Obviously, it's a long-term investment, and I think people who are 20 or even younger, they should look into it. And there are some perspectives, although I don't think anybody will ever make money on railway these days. America is being built on use of car, and I think it's not going to change in the next 625 years. So therefore, all attempts about whether it's railway trams or buses, or actually buses have some chances because they're using essentially the same roads what the cars are using. Actually, in Toronto, very interesting way of transportation. They have community buses which have a preferred way of traveling, so they can travel potentially faster than cars. They do certain stops here and there, and but they have right lane, which the cars cannot use. So they are basically being used instead of railway trams and subways, which is very costly to build the infrastructure and so on, and the electric lines or so on. And maybe that's some kind of future way of public transportation. And the bullet trains in North America, I'm skeptical on that, and even if I would be positive, I would not invest simply because of my age. I will not believe through to be.
What kind of trains? What kind of trains, Sasha?
The bullet trains, but wouldn't you also have to invest in existing rails? And Jim, correct me if I'm wrong, but there are hundreds, if not thousands, of miles of rail that exist that is not being used because the train system was more intense at one point. So if they're going to build a bullet train, I would think that they would need to build it either on top of or around what was the existing rail system. But that is what my own philosophy would be. Am I correct or incorrect in that, Jim?
Is a bullet train a magnetic levitation train? Maglev train?
Not as far as I know, no.
Oh, well, maglev trains, magnetic levitation trains do have a future. They have them in a few places. They have them in China. They go just about as fast as airplanes. And smooth, and we'll be seeing more magnetic levitation.
Yeah, but it requires colossal investment. It's not available in North America.
Well,
it's not
the issue in North America, basically, I can speak in terms of California anyways, it's you have to get many municipalities to agree.
Yeah.
And you only need one or two municipalities to say no. Mm-hmm. And you can't get it done. We tried in California for over a couple of decades now.
Really?
And it's
Jim, guess what? Durham is a prime example because right now the municipal rail might be going from Charlotte to Raleigh or a couple of other places, but because of the powers that exist, both corporate powers like GlaxoSmithKline and university powers like Duke University, there has been a lot of pushback by those municipalities, including the municipality that I live in. So Durham has not been exactly on the rail bandwagon because of the fact that it will necessarily hurt in their mind.
It's their way or the highway.
Right.
Well, the choice of using the auto industry for our primary transportation purposes is a very interesting story in the mid-20th century. A biography of Robert Moses taught me how it was decided. And, there's a lot of like Goodyear Tire Company was behind it. So again, it was making the politicians decide to do this. It could have decided to put trains in high-speed trains across the country in much more convenient ways for mass transit. But they decided because people could make more money off of the auto industries, and they supported it. And of course, who's to say they were wrong? Except that we're now seeing the results of our addiction to autos and our addictions to fossil fuels. And these types of things are not easy to get over.
Detroit saw to it. The streetcar tracks were taken out of every community in North America except San Francisco and Toronto. Because with no streetcar tracks, people have to buy cars. So Detroit saw to it to remove all streetcar tracks in every community except San Francisco and Toronto.
And remember, their only interest is profits for their company.
Of course,
They're not interested in the social good of the community.
Of course, yeah.
You can see that from the highway system. The highway system was intentionally, you can look up the history and everything, people that are watching, but it was intentionally put through poor and minority communities, often affluent. They're not people that were necessarily going to fight back. And that is part of the legacy of the interstate system. And that is throughout America, that they have intentionally had to go that were felt to be us in that space. I think
But
you
Sasha's right. I don't see that changing anytime soon. And, so, maybe for the young to look at that.
I would like to mention two very simple aspects of cars versus other ways of transportation. With a car, you can get from the door of your house or apartment or wherever to any destination you wish in North America, whether it's a half-an-hour drive or 5 days drive, it doesn't matter. From
You can
point A to point B, you arrive. And number two, very important consideration is that Americans and Canadians value their privacy very much so. When you are in your car, in your own private space, you can do anything what you want in your car. You can talk to anybody on the phone or whatever. You don't care about what other people are doing, where they're going, whether you like them or not, or whether they're threatening you or not, or you don't care. You are in your own.
In our area,
irreplaceable.
In our area here where I live in Collingwood, Ontario, they are building new developments with no sidewalks. No sidewalks. People are not going to walk. They're going to drive their car every place they go.
Absolutely.
Yeah.
There was a Steve Martin movie. I don't know if it was LA Story or what it was, but he got out, he walked out to his car and he was going over to his neighbor's house. It turns out he drove to his neighbor's house, which was, like 15 feet away, and then got out of his car and walked out into his neighbor's. So, it was making fun of us because that's really how much we love our cars, because of that independence that Sasha mentions. And, that is something that it's going to be very hard for people to give up. And it will take some sort of crisis, like when we can no longer breathe the air. It's going to be something that dramatic that people will give up that right to privacy, because we think of it as a right, but really it's a privilege.
Okay, let's get away from cars for a second. Jim, I was thinking about what you said before that about the Milan's model, and it's right for him, and my model, which is right for me. But I think it's a little bit misleading situation. Why? Because we are discussing fund portfolio.
Yeah, right.
Milan's strategy is not for fun at all. There is no fun in his strategy.
I think you're making a good point, Sasha.
So why don't we, first of all, define what are we talking about? I'm talking about fund portfolio only because my core portfolio, it's so horrible that I don't care even to talk about it. Okay, so I got, I think I got 3 or 4 months ago, probably, I got my dividends, and sometimes in August, I will get another dividends check. And then what is it that's so great about it? There's nothing even to discuss. And the fund portfolio, that's what makes all the difference. And this is where I'm looking not even as an addition to my core portfolio, but sometimes even as a game in itself, because it produces much more profits than my core portfolio. There are reasons to that, because I'm taking much a bigger risk in my fund portfolio than in a core portfolio. So
what we talk about when we talk about the fund portfolio, and I take your point, I think it's correct, that we should also say it should be money that you can afford to lose. It has to be discretionary money. And it's fun because if you lose it, you still go about your life. You don't have to, worry about paying rent or anything like that.
Well, let's see, in practical terms, so I did it 30, 20 years ago. If your core portfolio is 100%, and with a reasonably prudent investment, you should generate 10% annually. sometimes you'll do better than that, sometimes you'll do worse than that. But on average, it's achievable goal. If you want a correctness that's only 6.5%, I will agree with that as well. But to make arithmetic simpler, I would peg it at 10%. Why? Because if your fund portfolio is 10% of your overall portfolio, and you lose this 10%, I refuse to see how anyone can lose 100% of the fund portfolio. It must be really, really dumb and very, very.
Options can do it. Options can do it.
Well, if you're buying
saying.
okay, if you're systematically buying options using 10% of your fund account, in 10 months you can lose actually 100% of it. But you're talking about very damn situation, really. I don't want to offend anybody. However, if that's the case and your 10% or so profit from your core portfolio will essentially reestablish your, if you wish to continue, will reestablish very easily within a year your fund portfolio, provided that you lost 100% of your fund portfolio, which to me is unthinkable.
Right.
But Milan is right. Yes, it's possible.
Yes.
Now, if your fund portfolio is small, as it should be, and it's made up of, let's say, 4 or 5 stocks, that's very common, what possible difference could the movement of any one of those stocks make overall as a percentage or even as actual money? You're talking about such a small amount of money so that you can afford to lose it completely. You'll never make a significant amount of money if a small amount is involved. Put all your eggs in one basket and then watch that basket is what Gerald Loeb suggests. And that one basket should be the American economy as a whole. And then it's not much fun. Yeah, that's like watching. It should be like watching.
Let's get practical for a sec. I don't consider it will take your time productively enough if your fund portfolio is less than, say, I would say $50,000. And ideally, it should be $100,000, but not much more. I wouldn't entertain a possibility to have, say, $500,000 in fund portfolio, because now you cannot take too large risk. Even if you want to go into stock like Nvidia, it's still the risk-reward ratio exists even there, even if you have somewhat large account. But again, you cannot move big money into somewhat risky position, as Nvidia obviously is. It's very rewarding situation, but it's also a risky situation. So you have to get in the small, like maybe $100.
We never talked about this, Sasha, but my fund portfolio was $100,000 to begin with. Exactly.
Okay. I think it's a great size. 50, I think it's on the low side. 100 is a perfect size. But if you will move to 200 is okay, but even $250,000 to $500,000, especially $500,000 or higher, I wouldn't be so aggressive in that. You know what? I would divide it probably in two, maybe $250,000, and then separately another $250,000, which I would keep probably in cash-like situation, like some treasury bills or so on, and actively trade the other $250,000. So this way, I would sort of deal with the risk factors.
But to get back to discipline, I'm violating one of my principles. Was I doubled my money more than that with Nvidia, yet I haven't sold it. So I read paper gains, and I always used to say, if I double my money, that's when I get out. Or I eventually changed that strategy to sell half, so that I got back my original investment, and then I was playing with house money.
Okay, it's always nice to play with the house money.
Yes.
And, right now, I am playing a lot with the house money. But still, it doesn't matter whether I'm managing my own money or house money, as you say. See, Nvidia is a very special case. And of course, doubling your money on Nvidia, or some people believe that once you make 25% profit, you have to exit your position.
Right.
I had at one point, really a lot of shares of Nvidia, and it was a very high reward ratio position, and I sold some of it. I still have, believe it or not, even now with Nvidia, it's trading around 430 or something.
It's gone down. Yesterday it went down, I think, almost 10 points, but yeah, it's around 4.
Hey, Sasha, really
I'll
quickly.
tell you exactly what it is right now.
Yeah.
Okay,
Sasha.
speaking about AI, it's down 10, almost 11%. So it's Mark asked me about AI stock, artificial intelligence. I'm watching it. Maybe I will buy, but the timing is very important. Right now, I don't believe the timing is on my side, so I will not do that. Now, Nvidia, I will tell you in a sec what it is. Nvidia is right now
428.
428.36. That's where it is right now.
Along those same lines, Sasha, should people be paying attention to people that are making what y'all have made very clear are risky moves? Because before we started and before Jim and Milan joined us, I had mentioned that Charles Schwab is getting in the cryptocurrency space and all along those lines. And definitely Charles Schwab is considered a safe bet, I would think, in the finances and everything, but they are taking what appears to be a risky move. So should folks be paying attention to that and all in that space? Because Charles Schwab, I think, is got a solid history, but y'all know better than I do.
Well, yeah, I used to work for Schwab. I can tell you the history of that. Was Schwab was a rebel in that he started this discount brokerage when all you had was full brokerage accounts. People gave you advice and that kind of stuff. And so,
sorry, I'll be right back.
Of course, Sasha. And so Schwab actually became this discount brokerage firm when everyone told him you can't make it.
Yeah.
And then he ended up selling his company to the Bank of America, but he didn't like the way it was run, so he took it back, and everybody criticized him for taking it back.
He's never been disciplined by the Securities and Exchange Commission, which all other banks have been.
He's amazing, and well, that's my opinion. But he also started with mutual funds, and people said, "You're crazy! Don't get involved in mutual funds, individual stocks." So he's always been kind of like ahead of what the market is generally saying is the wise move. And he's been right at almost every step of the way. Going to the Bank of America probably was a mistake, but getting it back from it that's when I joined it. And that turned out to be a very wise move. So to hear that he's into crypto now, or, I think he's out of the game himself personally now. So it's somebody else making those decisions. But that's my inside kind of sense of it. So I don't know what their track record is going to be, but it's consistent with them being, although they've been solid, as you were saying, a very good company. I made a lot of money investing in Schwab stock, but this is a riskier type of thing than mutual funds.
This might interest you. I have a daughter and a son-in-law, both of whom are in the film business. Mm-hmm. And there's a writer's strike on right now.
Yes.
And the writers are concerned about AI taking over their jobs. My daughter and son-in-law are not going to have a job for the rest of the year because of that writer's strike, which affects so many people. Toronto is one of the major film centers in North America. San Francisco, Toronto, New York City, those are the ones.
Also Vancouver.
Yeah. And so here's my daughter and son-in-law will be unemployed for a whole year because of the writer's strike. And one of the main causes of the writer's strike, not all, but main causes, is that AI can do what most of those writers are doing.
Not as well.
Yeah, that's the whole thing around ChatGPT and some of the biases that exist in that and all in that space. Hey, Jim and Milano was going to ask Sasha as well, and I was actually going to ask it in a somewhat teasing way, but somewhat serious as well, because I know that there are certain things that we have to have on a regular basis, and I would think that they might be good, solid investments, but then again, maybe they aren't, because I know that some people that were into bananas and they invested in Dole bananas and all in that space. So I'm actually having in my hands right now, because it's going to be my little dessert, some strawberries and all along those lines. So should I be investing in food products as well, or is it an unsafe betting tool in
Don't buy tulips?
Well, regrettably, the best investment out there, unquestionably, is a marketable skill, which means keep working.
Mhm.
Yeah.
Well, that's for sure. But if you're talking about commodities trading or that sort of thing, this is another skill set. It's not my skill set, so I don't do it. But people that are aware of these types of trends within that particular investment strategy, they have their own rules, own regulations, own deals that I don't have enough expertise in that area to comment on intelligently.
So you're not going to go invest in chocolate milk, huh?
No, because I just don't know the dairy industry very well.
Maybe Milan's going to invest in it. I know that he invests regularly in dental equipment and all in that space, because definitely there are the fact that he used to be a dentist. So I'm sure he invests in some of the companies, even though I think he's a retired dentist. So maybe he's invested in retainers and all in that space, because there's got to be some retainer companies out there also that might be helping all these young folks and even old folks that are getting those.
That's an interesting question, Mark, because I have, my dentist who I had for years retired, and the new dentist, his equipment is unbelievably more sophisticated. And I was stunned. Like, instead of this big X-ray machine or something like that, you just hold something up to my side of my face and takes an X-ray, and there are other types of tools that they have, and they can show me right away what the X-ray looks like, and it's amazing.
Email it to a colleague anywhere in the world in a matter of seconds. Yeah.
Yeah. And so, I think dentistry in Milan, of course, you would know more than this, but I don't think when I was young, getting my first cavities filled, it's the same. I think it's tremendously different now, because I've had a whole bunch of those old ones, which lasted about 50 years. So I'm giving them a lot of credit. I mean, they did a good job, but they're having to be replaced, and the replacement is very different than the original experience.
In dentistry, try to make things last forever. And we're actually offended by things that are made to last 10 years. So your refrigerator is designed to work for 10 years. Your television thing.
Planned obsolescence. Yes.
Planned obsolescence is one aspect of the free market capitalist economy.
Yes.
One of the shameful parts of it.
I agree.
The free market capitalist economy has lifted more people out of poverty than any other system, has created more wealth for more people, but it does have its dark underside. And so how are we going to get rid of that except through regulations?
Milan, along the same lines, I know it's an investment show, that dark underside, though, I just recently, and I think I mentioned it one of the other times that I appeared here on the show with y'all, I just recently, I think it was, and I'm not wearing them now, I should be wearing them, but I just recently got my new eyeglasses and had my eyeglass appointment, and it seemed to me that in the older days, you would maybe do the whole look at the images and all in that space, and it was like maybe just one or two tests, but I think that they gave me like 3 or 4, maybe even 5 machines, and I sometimes wonder, did they need all of those machines, or is that just part of the rising of the eye care?
The people who sell those machines,
they
also rose the price well.
Well, I think those are the new technologies that, and Milan, you brought up a stock that was introducing a new treatment for types of cancer that was available now, or was okayed in Japan. I can't remember what stock that you recommended. Selba
I can't recall it either, but
I can't come up with a name, but it was using ultrasound in a new way.
Right. Yeah, that's right.
Yeah. And it was like, I was thinking, like, the treatments for pancreatic cancer, for example, have been fairly horrific. And this sounded so much more benign. And, these advances these are investment opportunities, to my way of thinking. Yeah. I'm always interested when I see something like that come along. And of course, I've forgotten the name of it. But
we'll have the name for next week. But
in any case, because I wanted to track it, and then I got distracted by something else. But in any case, these types of advances in technologies are something that I always pay attention to. And if I look, are they tied to a particular company? Do they have a patent, which this company that Milan was talking about apparently did, and so that they can generate a certain amount of income? Because when it's all about it, when these stocks come in, are they making money? You know, that's the.
But Jim, along those same lines, y'all keep talking about the fund portfolio. How much can you have a fund portfolio of a industry that you don't know enough about, or can you have a fund portfolio in something that is not in your own knowledge base? Because you were describing this, I'm going like, I have no clue about the medical industry, so I would probably not be thinking that that would be all that fun because I don't know that particular industry. So how important is it within the fund portfolio for it to be something that you literally understand, or can you have fun with something that you don't really have a knowledge of?
I'll let Milan talk to that, but my first response is that I get interested, and if I'm interested, it's fun. And you know, my curiosity was piqued by what Milan was talking about, so I really got, you know, now I'm going to inform myself, and I'm not going to like invest because he told me about it. You know, to me that's nuts. I'm not going to invest because somebody was selling it on TV. You know, to me, when I was young, I might have been kind of carefree that way, but no longer. So what I would do is research.
The approach you describe here will make you more effective and a better human being because you will know more. Yeah.
And well, this is the partly my father's upbringing, and what he taught me to do is he said, never wait to be taught, teach yourself. And so I thought when I started investing, I spent, before I spent a dime, I did a lot of reading, a lot of research. And I did do things like watch the nightly investment shows, religiously. And when I first started buying, I was buying some of the things that they were selling. And, then I wised up. I realized that, this is, what I have to do now, what I get curious about, I get informed about. And when I informed, I make rational and fact-based decisions. So I get the emotion out of it. It's not something that I like the sound of it. I hope that they can do this procedure well. So I'm going to invest in it. You're not going to
invest because eBay told you to invest?
Or for lunch, I run, the foundation is philanthropic. It's a charitable organization, but my investment is not. I'm not giving anybody money to, just to help them make the world a better place. But I will not invest in things that I think are harming the world. And so that's part of my discipline.
Just a second, Jim. You did give us some money to make the world a better place. You donated some serious money to our chess festival, which we call in Collingwood annually, and we are doing that to make the world a better place.
And I was proud of that. But that's part of my philanthropy.
Hey, Jim, you just mentioned something that I've heard people talk about before, and I'm actually a fan of it, but not everybody is. But what is your thoughts and Milan's thoughts about what is called social impact investment? Because that is something that I've heard a lot of people talk about, where they will invest in something, not necessarily because it's going to make money per se, but because it's going to make the world a better place, for lack of a better term. I've heard this term used by a number of folks, of social impact investment.
And they're called green funds. A lot of them, anyways. Mm-hmm. They're called green funds, and they will always have a soft spot in my heart for them.
Yeah.
And I think that's a place for your discretionary money. It's not necessarily part of your core portfolio. Your core portfolio should be, we're planning on making money so that we do not have to be dependent in our old age.
Yeah, right.
And we're planning on having security for our loved ones as well. This is the goal of my core portfolio, so that I do not have to hope that someone takes care of me, because I can pay them to take care of me. Or, someone I love is suffering, I can afford to take care of them. That's what my core portfolio is about. So it's pretty selfish in a way. But it's about my loved ones.
Yeah, Adam Smith said it isn't from the benevolence of the butcher and the brewer and the baker that we get our dinner. It's for their own self-regard.
Yeah. And there's nothing wrong with that. This is fine.
Yeah.
It's the what you were saying, the planned obsolescence thing, that then you get it, and they also the exploitation. If you exploit workers, if you're a company that does that, then I want nothing to do with you.
But Mark, what you brought up is called ESG investing, where you talk about the environment and social impact and governance, and those three. And those three criteria should have been in place long before the term ESG came out.
Yes,
Yeah.
I agree.
Yeah, I definitely agree with you on that and everything. I'm gonna let y'all have the closeout. Hopefully, Sasha is going well where he is and everything. But as I usually just do stuff in the background, and y'all are the regulars, I'm going to drop off and let y'all have any closing statements. And maybe Sasha is a listener and he may join as well. But I do know that we're pretty much at the top of the hour, so I'm gonna drop off. And if y'all have any things that y'all want to say in that closing, I'll let y'all do that since y'all are the regulars. And like I said, hopefully Sasha will pop on as well.
Okay, Mark. Milan, would you like to do the honors or follow me? It's your call.
I'll follow you, James.
All right. I would just like to say to the modern investor, the first thing you do when you're young is you save. And, part of my paycheck always went to my savings first, and that's because when I was young, I would spend it if I had it. So I always saved it first before I even saw it. I had it deducted out of my paycheck. And that's the discipline. And then you get into real estate. That's another thing we don't talk about a lot. We talk about it some, but I wanted to have a place where I could live. I could not be evicted from. That was really a part of it. And then, I used that first thing, step into real estate to get more involved in real estate and more. And then I started to invest in companies that we spend the majority of the time talking about, but you start with discipline. And you start by saving, you start by getting your foot in the door, and then you keep expanding from there. And stay disciplined through every step of this way. And you'll find that you might get unlucky, but more often than not, you will be rewarded by being disciplined.
Well, I can't improve on what you just said, James, but I'll tell you about what does work here. Right about saving. We talk about the 6 habits that highly successful investors have. And the first one is save. Without that, the other 5 don't work. The second one is do it yourself. It's easy to do it yourself. The third one is buy the American economy as a whole, not individual stocks. Stock picking works best with hindsight. Buy the American economy as a whole, which has had the best track record for over 100 years, so it's likely to continue. And the fourth one is buy and hold, no trading, except the fifth one, adjust to your asset allocation when market movement throws it off the asset allocation that you usually have. And the sixth one is, if you can't explain an investment to a 12-year-old, don't get into it. And those 6 criteria, those 6 habits that highly effective investors have work. That's what I adhere to, and that's what we recommend in the Monday morning program. And it's not momentum investing, which is what Sasha Starr does. Momentum investing also works. What doesn't work is mixing up the 2.
Yes.
Yeah. Stay with the one, then you'll do very well. Yeah.
Right. And learn from your mistakes. That's what I always say.
Yeah. Mistakes are practice shots.
Yeah.
Yeah.
All right. So we'll say goodbye here, and Sasha will be back in charge next week.
See you next week, Jim. So, Mark, see you next week.